You are listening to Keystone's Stock Talk Show, episode 189.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment, and we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week. We will start by covering a few topical stories from the past week, including RBC's $13.5 billion agreement to acquire HSBC Canada. In our recent client chat session a week ago, we fielded a question about which sectors or industries are best to invest in during the inflationary or rising rate type environments. Brennan will explore this on today's show, and we will discuss. In our Your Stock Our Take segment, we take viewer questions on three stocks. The first, Zoom Video Communications Inc., symbol ZM on the NASDAQ, which was essential infrastructure during the pandemic, but has since declined 85% the stock from its highs. The company recently released Q3 financial results, and we will review the performance to find out if this U.S. technology juggernaut is currently an opportunity for investors. The second company is a Canadian microcap, Ceapro, symbol CZO, a biotech company that develops technologies to extract active ingredients from oats and other renewable plant resources. The profitable microcap is actually up year to date, as it has produced record earnings per share. The listener asked if the EPS growth is sustainable, and if so, is Ceapro an underfollowed opportunity? The third is Voxtur Analytics, symbol VXTR on the TSXV Venture, a real estate technology company which offers targeted data and analytics to simplify tax solutions, property valuation, and settlement services through the lending lifecycle for investors, lenders, government agencies, and services. The stock is down 78% year to date, and a listener asks us if the huge drop is an opportunity or whether this dog will continue to bark. So let's get into the show. I'm going to welcome my co-hosts, Aaron and the Killer Bees, Brennan and Brett. How are you guys doing?
Doing well. Salutations.
Getting ready for Christmas?
You betcha.
Anybody?
Yep.
Nope.
I might be asking for
Aaron,
a couple
your
days
tree
off
up?
here.
Did we already ask that? Is your tree up?
Oh
Aaron?
yeah, no, it's up. It's up. My kids, they're it's basically October and they're bugging us to put up the tree. So yeah, tree's been up.
I never
weeks
took
now.
mine down. So
No,
I just leave it up the whole year. No, we put it up on the 25th. That's pretty early, actually, of November. Brennan, where's your tree? Come on, you need a tree in the background.
My mom insists that she make me a little one, but I don't know.
Yeah, you know what? I was a single
bring it?
guy. I never bothered with trees. Never gave out candy on Halloween. I look back now and I'm like, was just lame. But whatever. I get it.
Grinch, clearly.
You're a young bachelor. You're spending your nights out on the town.
Yeah.
You don't have time to take care of trees.
Totally.
Artificial trees.
But it is nice. I always go home to PA, and my mom, where my hometown, and my mom always has the place decorated very beautifully. So it's always fun to go back and actually get a little bit of the Christmas spirit in me, because I am Grinch usually. Yeah.
You heard that? No, you're not. Come on, you're
I know.
You're full of it, and not the Christmas spirit, but you're just full of it.
Yeah.
So okay, well, I think that's it. Well, let's just get to the show. Royal Bank, a proposed $13.5 billion acquisition of HSBC's Canadian operations. It would be the biggest Canadian banking deal in a number of years. If we look at just the concentration in the Canadian banking sector, Canada's big six banks are estimated to control around 80% of the total assets in the country, total banking assets. By comparison, if you flip that to the US, it's a much more fragmented market. The five largest banks in the US control just 40% of American assets. That's according to Reuters data. Outside of the big six, HSBC Canada is one of the larger Canadian banks. So if this deal does move forward, it leads to further consolidation and further market share of the Canadian market by the big six. So that alone is likely to have Canadian regulators looking closely at this deal in a country where the banking industry, again, like we said, it's already highly concentrated, and RBC is the biggest lender. So there's some chatter out there that Canadians government has, been fairly vocal in opposition against industry consolidation. So regulators, there's chatter that maybe they require Royal Bank to divest some assets. That would probably spell trouble for the deal. I'm not sure if they got into this to divest some assets. The rationale behind the merger is dependent on kind of cost synergies. So, you'd probably want to keep your existing assets. So we'll see how this goes through. It certainly does, again, consolidate further the Canadian markets, which for some people kind of lack in competition. I don't know if anybody had any comments on that.
Yeah, I mean, I've done research just on breaking down the Canadian stock market into its sector categories, for example. And you'd mentioned 80% of the banking sector is just allocated to the big six banks. Well, 25% of the Canadian stock market is also allocated to banking and finance. So it's so you take 80%, 25%, you're looking at what 20% of the market is just in these big six banks. So we've always said very concentrated market up here in Canada, very concentrated sector as well. It's difficult to know how the regulators are going to look at something like this because, in most industries, they want to push against oligopoly. Whereas in our banking industry, oligopoly is just the norm, but it is also a highly, highly regulated industry as well. And just on your comment about how it differs from US banking, there are hundreds of regional banks in the US. We go
publicly listed. When we go
list.
through, there's so many regional banks.
So many regional banks from small to mid-size, and you just don't see that in Canada. I mean, up here in Canada, there's a handful, and I'm not talking about relative to population. There's just a small handful of, I'd say, mid-size banks in Canada where it's quite the market. In the US, you have to look through quite a few. So completely different operating environment. Difficult to say what the Canadian government's going to do if they think that this is going to make the financial industry in the country stronger or weaker. We'll find out. Brennan?
Yeah, I was just going to say my friend Grady, he actually works for HSBC.
Yeah, Brennan knows some big wigs up at
I don't know if he's a big wig, but he is a good friend.
I don't know
I grew up with him.
Disclose this
in my hometown. No, it wasn't inside information. But we were just talking about it, and he was just wondering or kind of thinking like there's a lot of chatter going on in the office. How are they going to rebrand? Essentially, is it just going to come right under RBC and just be RBC, or what are they going to do there? And then also, a lot of people concerned about whether they're going to keep their jobs or not, including my friend. He thinks that he's got job security, but who knows if they go through and they cut a lot of jobs. So he is an associate. I think he's been there about 2 years. Good guy, hard worker, smart kid. Hopefully someone from HSBC is listening.
Brennan's selling him.
I'm sure that's what's going to tip the scales if we have one of the upper executives that listens.
Forward this podcast.
Well, Brennan knows him, so
good guy.
I'm going to take just a wild guess that they're not going to eliminate the brand, that they're going to keep the brand because they, RBC is already such a wide brand, widely available brand in Canada. There may be some loyalty, at least at first, to the HSBC brand, so maybe they don't want to rock the boat too much. I definitely think some people are probably going to be cut because that's often what happens when you bring these.
They literally talked about cost synergies.
Yeah, so certainly. It's about cost synergies. So we're all gunning for your buddy there. Not saying anything about him. Know nothing about his position.
He's indispensable.
What sometimes happens though is that you and this has happened to friends of mine that work at the bank before, is that they consolidate offices. They move, say, certain functions that were distributed all over the country or in different cities all over the country to Toronto, and they basically give the ultimatum: you can move to Toronto and keep your job, or else you.
There's a place called Toronto in Canada. What?
We were even just talking to a company the other day, and they were talking about, or the CEO was talking about, cutting some sales jobs and just putting more accounts under, individual sales representatives, to get rid of a few heads. same sort of thing.
But you never know. Even if they cut your friend's job, if he's a good worker, then there's a labor shortage out there, so they don't like to get. It's a different environment now, right? So they don't want to get rid of good people, even if that job has got to go. There may be something else that you can get into, maybe something even better.
Mm-hmm.
Okay, well, let's. I think we just want to get into that question. We took a question. We take hundreds of questions each week in our chat sessions that we do Mondays and Wednesdays for an hour and a half for clients. We had a question in there we thought would be interesting. We can share that here. It was about essentially which sectors or industries are best to invest in during inflationary or rising interest rate environments. There's a playbook that you hear when you're in school, and then there's what you want to actually use in the real world in some cases. So Brennan's going to take you through that, and then we're going to, rip them apart.
I'm excited.
Excited to rip me apart. Yeah. So thanks for outlining that question, Ryan. And just looking at which sector or industry is best to invest in during an inflationary or rising interest rate environment. Some analysts would say utilities, because many of their contracts are indexed to inflation. I actually spoke to Ryan before the podcast, and I told him this is actually something that I was taught by a professor in school. And other analysts would talk about, consumer staples, healthcare, maybe gold, all because of their defensive properties. But what we would say is to have a diverse portfolio of stocks from many sectors and make sure that you look at the balance sheet to ensure a business does not have too much debt. And if they are levered, that most of their debt is fixed rate rather than floating rate. So they aren't as sensitive to those interest rates rising. So for example, this was also a question on a company that was actually asked in that chat session. So I'm going to look at Stanley Black & Decker, or SWK, on the New York Stock Exchange. So let's take a look at whether this business would be a good company to invest in during a rising interest rate environment. So looking at the balance sheet, the company has about $408.7 million in cash and $7.9 billion in debt. So that provides a net debt balance of about $7.5 billion. But is this debt sustainable, and is it primarily floating rate or fixed rate? So first, regarding the debt sustainability, the company has a net debt to adjusted EBITDA multiple of about 5 times and a times interest earned ratio of approximately 3.2 times. So just looking at these two ratios, the balance sheet, it is definitely on the higher end of what we would be comfortable with investing in. Now, second, regarding whether its debt is floating rate or fixed rate, I took a look into the company's filings, and the company's $5.4 billion in long-term debt is primarily fixed rate, whereas its $2.5 billion in short-term debt is primarily at a floating rate. So essentially, if interest rates went up by about 1% or 100 basis points, we could assume that its interest expense would go up by approximately $25 million. Now, we can also look at what U.S. rating agencies are saying about the company's debt, right from their 10Q or their quarterly results. So on its senior unsecured debt, S&P had a rating of A, Fitch had a rating of A-, and Moody's had a rating of Baa1. So I believe all of those are investment grade, of course. And then looking at the commercial paper program, same thing. S&P has a rating of A-1, Fitch of F1, and Moody's of P-2. So there were no recent changes to any of the company's credit ratings. However, Moody's Corporation recently changed the company's outlook from stable to negative during the second quarter of 2022, and Fitch changed the company's outlook from stable to negative during the third quarter of 2022. So these rating agencies essentially are seeing a bit of a dim outlook for the company going forward. So just by looking at the balance sheet, this is not a company that we would invest in during a time of rising interest rates. I could also elaborate that the company recently lowered its guidance, which is maybe what caused those rating agencies to lower their outlook for these companies. But, of course, that's a concern looking forward, especially when a company has, this much debt in a rising interest rate environment.
Good job. And I would agree.
Rip me apart, guys.
So it's I'm not gonna. No, honestly, that was a good analysis. So a debt to EBITDA 5 times.
Yeah, 5 times.
Yeah. Okay.
Net
And
net.
Stanley Black and Decker, this is a tool company.
Yeah.
Yeah. Yeah. So I would
Cyclical.
say like maybe, it's consumer, is it classified consumer defensive, consumer cyclical?
I think it would be cyclical
You
more,
would
but
think
you know,
it is.
I'd
It
have
is.
to.
It is a strong brand. So I haven't looked
Mhm.
at the historical financials to see how volatile they've been. But yeah, those sound like pretty high leverage ratios to me.
Yeah.
You know, that said, the rating agencies back them up and say that they're investment grade. So based on the track record of the rating agencies, I mean, they've always provided great independent analysis through financial crises and whatnot. So we would definitely just defer to them and not even
Except for
do any
08.
analysis ourselves. Yes, I'm being extremely
I
sarcastic.
know.
Yeah. No, I mean, I think that that's a leveraged balance sheet. Personally, it's the leverage is uncomfortable, and for me, and 5 times debt to EBITDA. So for some industries, like if you're looking at a utility company, like a regulated utility, maybe that's not that's typical, right? But the more cyclical a business is, the less visibility and stability of cash flow in the future, the lower you want to keep those leverage ratios. So if you're looking at like a truly cyclical company, you want to have that generally like debt to EBITDA less than 1. Most of the stocks, I'd say, like, just without looking at the financials on this company, the 2 to 3 times is often kind of where I see like a lot of the leverage ratios in most industries, which is fine depending. But 5 times is sounds high to me. I mean, once again, I've not looked through the financials myself. So
Yep.
Yeah, and I mean, the part of the playbook that you typically hear about in a rising rate environment is financials. They can often get a better spread in that environment, but I mean, you got to take each situation economically unto itself as well and look what's going on. Like if we have rising rates in this environment, and for example, I'm not saying this is going to happen or anything, but if the housing market collapses, it doesn't help many of the banks out there that have lent a lot into that segment. So insurers typically are supposed to do well. And then Brendan talked about consumer staples as well. But looking at each individual business, you could have a consumer staple company that's extremely highly leveraged and it's on a floating rate, and they're going to get squeezed on their profit margins, even though people need to keep buying their goods. But if they've over leveraged the balance sheet, that's why we're always loath to just say this is the sector you buy when rates rise. This is the sector. You have to look at each individual company as well, because you can have a company that should do well in an environment, but if they've done something wrong, like if they borrowed too much money, like we said, and rates rise and it's on a floating rate, they're going to get squeezed on profit margins. So look at each individual company.
Let's go back to what people were saying 9 months ago, right? We had inflation was building up, so there's high inflation. That is what has caused the interest rate increases that we've seen. And people are asking back then, well, what do you invest in a high inflation environment? What was the most common answer?
Right?
Commodities, right? And metals and other commodities like lumber were performing extremely well, right? And that was, typically, if you look historically, commodities is a place you can go for inflation protection. Well, certainly not this cycle, because commodities over the past 6 to 9 months have been absolutely killed. And, with the exception, of course, of oil and gas. But, outside of energy, like metals, copper, lumber, iron ore, like those commodities have had horrible performance, worse than most sectors, right? So if you are trying to take this investment strategy where you're like, okay, well, I think there's going to be high inflation, so I'm basically going to bet on that, and I'm going to make a guess as to what sectors are going to do well and throw all my money into that, you're setting yourself up for complete disaster. And that's what would have happened to anybody who went commodity heavy 9 months ago. Now, do I think commodities have a place in a portfolio? I think that they likely do. But these are cyclical areas of the market, very high risk, and you need to invest in them knowing that there's going to be a lot of volatility. So you keep that allocation low and you mix it with other types of businesses that have strong long-term growth drivers. Another thing I'd say, because we've been using the terms like consumer cyclical, consumer staple, consumer defensive. So consumer defensive, consumer staple kind of means the same thing. It means things that people buy regardless of whether or not there's difficulties in the economy, right? Things that you need, like toilet paper, for example, does not mean that all of the companies that are classified as consumer staple or consumer defensive are going to actually be defensive during a recession, because you have no idea in terms of what just by looking at the sector category, what type of competitive pressures they're dealing with, what types of cost pressures they're dealing with. Cost pressures like everybody else, higher input costs, higher wages during the supply chain issues, higher transport costs. So just because a company falls into that category, don't in any way assume that it's actually going to behave like that in a recession. You need to do your homework and also just mix it around, like Brennan said. Mix your, and I don't just mean having a little bit of everything. I mean, identifying a collection of strong markets to invest in and profitable companies in those markets.
Yep.
Yeah, I mean, gold stocks, in an inflationary environment, were supposed to do incredibly well. I mean, I'm not saying that that's what we predicted or anything like that, but at the start of the year, there was a ton of questions we got, this gold stock, that gold stock, many gold exploration companies. I did talk at a conference related to that segment at the start of the year, and it was quite busy. Do you guys know what the TSX Venture has done this year in terms of performance? No Googling it right now. Just give me.
I'd say like 60%, down 60%.
Yeah, it's down 38%. So one of the worst performing indexes in all of North America, obviously, like if not the worst. And it's a proxy for junior gold companies, really, right? Junior metals companies, and that's despite like there are some energy companies, oil and gas, like juniors on that would have had a pretty good year to date, but just the sector is or that exchange is absolutely cratered this year. When you think, there's a ton of oil mining companies on there, right? Like it was supposed to be the playbook that commodities were a good place to be in an inflationary environment. As far as those exploration companies, not a great place to be this year at all.
I think that was one of my predictions in 2022 to throw myself under the bus. So, yeah. Whoops, wrong.
Quit throwing yourself. All right. So let's look at another company, another segment, technology. I mean, it's a theme not doing so well in 2022. But Zoom, Aaron, you got a question from a listener on
technology.
Zoom.
Yeah, technology, specifically software technology, has by a wide margin up until the last year been the top performing sector in essentially all of for the past decade. So this has changed over the past year, and we're going to take a look at one of the companies that was the top performer in the space, and that company is Zoom. So I'm interested to take a look at this company. They just recently, about a week and a half ago, put out their third quarter fiscal 2023 results. And it's a name that I've been keeping an eye on. So Zoom Video Communications, ZM on the NASDAQ, trades at $72, market cap of $22 billion. This is the largest video conferencing platform in the world. Nobody needs an introduction to Zoom. We've all used it during the pandemic. Critical infrastructure when we were all locked in and shut down. And even as things opened up, the usage of Zoom skyrocketed. They have a global market share of 48%. And I believe that's even higher, above 50%, just for the US market. So as I said, one of the top performing technology stocks during the pandemic, but since then, catastrophic performance, one of the worst performers. The stock price peaked in around October of 2020 at $560 per share, touched up to that level. Since then, it has declined 87% down to $73, and the decline continues. So given that this was an incredibly important company, they continue to operate, they continue to have a dominant market share in what I would consider to be an important space, and it's come down so much. We want to see how did the company perform in its last quarter, and is this a great value opportunity in the technology space right now? One would think so, with the stock price down 90%. Otherwise, investors really had it wrong back in the last quarter of 2020. So as I said, the company recently put out its Q3 fiscal 2023 results. I have some of the select financials. Our revenue was up about 5% in the quarter to just over 1.1 billion. On a constant currency basis, it was up about 7%. Gross margin improved slightly, 75.4% gross margin compared to 74.2% in Q3 of the previous year. But GAAP EPS, so reported earnings per share, down 86% to 16 cents from $1.14 last year. Now, if we look at non-GAAP or adjusted EPS, we adjust out a lot of things, what the company would consider non-recurring costs or non-cash costs, which is largely stock-based compensation or expenses associated with acquisitions. The numbers look better, but still down 4% in the quarter to $1.07 compared to $1.11 in the third quarter of the previous year. So it's not all negative. If you look at some of the customer metrics here, some good points to be made. Enterprise customers up 14% over the same quarter of last year. Enterprise customers are spending more money, about 70% more money on average. More customers contributing more than $100,000 a year. That has increased about 31%. It's pretty impressive. And then churn down. So the customers that are leaving the company down 60 basis points at 3.1% for Q3. So all of these metrics look good. The company has put out financial guidance for the upcoming fourth quarter, and for the full year. So at the midpoint for the fourth quarter, they're expecting non-GAAP earnings per share of 77 cents. So this is down fairly substantially, a little less than 50% relative to non-GAAP EPS in the previous year, which was $1.29. And then for the full year, the company is estimating earnings per share non-GAAP of $3.93 compared to $5.07 in the previous year. So what we are seeing is, at least on a GAAP or adjusted basis, good, strong profitability, but the company has not bottomed out yet financially. We are seeing declining earnings per share here. Now, this is not necessarily a terrible thing. We do have to remember the company is coming off of what was absolutely historic demand over the past 2 years. So it's absolutely reasonable that we should expect, the earnings and even the revenue to drop. Well, revenue is not dropped. It's more or less flat, up a little bit. Earnings have dropped, as well. Higher costs are going to play into that as well. So just looking at these numbers, not too bad. If we can take those non-GAAP numbers at face value. Now, we've had discussions about this before. There's a huge delta between the non-GAAP and the reported earnings per share. So reported earnings per share, 16 cents in the quarter compared to non-GAAP or adjusted earnings of $1.07. We need to understand that delta before we can really, take those adjusted earnings at face value. What I will say is the company produces a lot of free cash flow. So it's not a situation where the earnings quality would be weak, but we would still need to look into that. And then looking at valuation, over the past year and a half, it has been an absolutely incredible change in the company's valuation. So at its peak, Zoom had a market capitalization of almost $160 billion. It was trading at a price to sales of almost 70 times. Now, we would consider a price to earnings of 70 times to be very expensive, even for a high growth software company. But this was price to sales of 70 times and price to earnings well above 100 times. Now, with the near 90% drop in the company's share price, we're looking at price to sales of 6 times, price to earnings at 18 times. Once again, that's non-GAAP earnings. So from a valuation perspective, I would say it looks quite good right now. Another thing to note is that they have a very strong balance sheet, about $5 billion in net cash if you include short-term investments. So that's about, say 22% of the company's market cap. So a nice net cash position, very little debt, something that we like to see. So when we're looking at Zoom right now, how would we approach it? What are we seeing here? Well, one of the things is that the company's share price momentum has not stopped. It continues to go down. We are also seeing with the earnings figures that, that has not bottomed out yet. One thing we would like to see is for the earnings per share to bottom out and for us to get to a point where we're going to start to see the earnings starting to grow again, at least over the next, say, 4 to 6 quarters. Now, analysts believe this will be the case next year. They are expecting to see some moderate level of earnings growth return over the next year. If that happens, things improve in the economy, there's no other major surprises for Zoom, I would say that it probably represents pretty good value right now. I wouldn't jump in necessarily and take a big position in the company. People that are interested can maybe start to nibble away at the stock, take a small position, maybe, 10, 20% of a full position, whatever that is for you, and then look to add as we get more quarters. There's still a lot of uncertainty. And as I said, we want to really dissect those non-GAAP earnings to make sure that we can rely on them. Now, Zoom, along with some of these other tech companies, these big market-leading tech companies, which would include Intuit, DocuSign, Adobe, and several others. These are companies that we're keeping a very close eye on right now. Financially, most are performing reasonably well, but they're still, under pressure, at least on the bottom line. So we just want to get some sign that this is starting to ease, and that the negative momentum in the share price is also starting to stabilize. And we do expect to recommend some of these names in the near future. I don't know if it's going to be Zoom, but Zoom could be on the list. It is certainly something that we're monitoring very closely. And we would hope to be able to add a couple of these companies to the portfolio.
Good. Yeah. I mean, Zoom, it's an interesting case of, pandemic star and, certainly very useful. They've had good revenue growth. Just like you went over, those valuations during the pandemic were just insane. Like to have gone to those levels, it makes absolutely no sense. It made no sense then. And, now the valuations have come down. You went over them, Aaron, based on non-GAAP, they're starting to look better. But even based on non-GAAP, if it was 18 times, I think their revenue growth in the last quarter was 5%, 7% constant currency. And then you had declining earnings. And the projections from analysts are for declining earnings next year. So, I mean, one of the things we don't really love is to see a company, with, even if it's decent valuations, but if we've got declining earnings next year, I mean, then your price to earnings, price to cash flow, if it's declining cash flow, we'd have to look at that too as well. It goes up. That multiple goes up even if the stock stays at the same price, right? So it's not a formula that we typically like to see. But, Zoom's a company we'll continue to monitor if they can get growth. I mean, I would say, too, there is significant competition for this company. Good balance sheet, but two of the companies it competes with here, like Microsoft has Microsoft Teams, an awesome balance sheet there, too. And Google's probably got the best balance sheet on the planet, and, they would compete with them. And, I mean, we've all used all of them in terms of just for meetings internally or meetings with companies. They're all fine. They all work. So I'm not sure if I would, if I use Zoom and I said, I've got to use Zoom, I don't have any, whichever one's going to be, I mean, cheapest over the long term is probably the one you use, right? Or integrates
I find
well
Zoom a
with
pain in
your
the butt
system.
sometimes, personally.
Relative to what, though?
Google Hangouts. Google Hangouts is
Google
so
Hangouts
easy,
better?
very
Yeah.
straightforward, and it links right up with our calendars, which is very nice.
Yeah, I mean, everything has competition. I think one of the things that we would do to kind of analyze the competitiveness is look how the market share has trended. And I don't have the numbers for that on Zoom, but in terms of, putting together a potential recommendation, that would be something that's pretty. You want to see the market share continue to increase or at least remaining stable. If they're starting to lose market share, then that's a sign of trouble. And Ryan, you are correct. Analysts are actually expecting a very modest decline in earnings per share next year. I had said that they were expecting a modest increase, and they were previously, but it looks like those numbers must have been downgraded just recently. So I think analysts are looking at $3.95 in earnings per share on average for the current year and $3.62 next year. So
it's concerning.
You'd want to see some of those. You'd want to see earnings showing some signs of growing. But then once again, we also have to take into account the company is coming off of a period of historical demand. So it is not unreasonable to expect that there would be, some softening in the near term.
For sure.
Yeah.
All right, let's move to our next Your Stock, Our Take. That's Ceapro, symbol CZO on the TSX Venture. Company trades at 69 cents, a market cap of 52.4 million. So a micro cap, we'd classify it. It's a Canadian biotech company that develops technologies to extract active ingredients from oats and other renewable plant resources. The company develops and commercializes natural products for personal care, cosmetic, human, and animal health industries using proprietary technology, natural, renewable resources, and developing innovative products, technologies, and delivery systems. So some of the company's customers would include Aveeno, Neutrogena, Lubriderm, Gold Bond, Burt's Bees, Dove. So some of the names that most listeners have used and would know. So big name customers. Q3 2022 results. Revenues dropped 15% to 3.85 million. The decrease was primarily driven by a 17% decrease in product sales volume over the comparable period due to lower sales of the company's flagship product, avenanthromides. Oh, don't have words like that. Sales of these were lower due to timing of customer orders, is what management said. The company was hit by a double whammy, and yes, that is a technical term we use in finance all the time. The first would be revenues decreased. Number two, cost of goods sold increased by 12%. This resulted in a decrease in the gross margin from 65% in the prior quarter to 54%. Net income for the quarter was basically flat at $0.01 per share, around $0.01 in the same period in Q3 2021. The first 9 months did show a jump of 119% in terms of earnings, up to 4.52 million from 2.07 million. That's about 6 cents from 3 cents in the same period last year. So we monitor the company because it offers, a good balance sheet and it's profitable in the microcap sector. It trades at, like we said, relatively reasonable trailing valuations. One of our concerns for the quarter, which just was reported, and in the near term into Q4, where the company has used up all of its work in progress, that had been manufactured with higher yielding grain. So the work in process used to produce finished goods did not generate significant benefit from the high output of that grain. Now, they had benefited from this in Q1 and Q2. The balance sheet, Ceapro has an excellent balance sheet for a company of its size. 12.91 million in cash against 2.5 million in lease liabilities. Net cash is about 10.4 million, which is about 20% of this company's market cap. The valuation, the company trades at reasonable valuations. Like I said, price to earnings in the range of 10, price to FFO 6.5, EV to EBITDA of around 6 or slightly under. And the company does have a clear pipeline of future products, which could lead to a step up in growth at some point. But there are risks there that these products never make it to market, and we don't see that step up in growth. While driven by R&D and product development, the company has an existing profitable business, and its great balance sheet, like we talked about, which is a good start. Historically, revenue trend is on an upward trajectory over the last 10 years. Not spectacular growth, but it is going up over that period. There is lumpiness on a quarter-to-quarter basis. The current year is a step up in terms of profitability and tracks well in our models, but we expect the company will post compressed earnings in the fourth quarter compared to, say, Q1 and Q2, and it's impacted by those rising grain prices. It also will have increased R&D development cost. Management has telegraphed that. The grain prices have moved lower, but heightened development costs remain. Good for future, these development costs, likely. That's what the company's investing in the future. But it will face tough comparables in Q1 and Q2 year over year. As such, while we see value on the company on a trailing basis, we certainly rank Ceapro above most Canadian biotech companies. We choose to monitor the business given the near-term headwinds on the existing core business in terms of profit margins over the year over year. And this is a company that we did cover and look at in a recent Canadian opportunities report. It certainly ranks near the higher end of that report. We just see a little bit of potential margin squeeze in the near term and some year over year comparables that are difficult. It's overall, it's a decent business, and they really took a step forward in terms of profitability this year. I'm not sure if they'll have those margins over the course of next year, but it should still, be profitable, and they have a great balance sheet, so they're likely not going to have to go to the market in the near term and to fund their R&D endeavors.
Perfect.
And that's all.
Excellent.
You guys got nothing.
Excellent.
I like
So
the
it's a
whammy
buy.
reference.
Yeah, you heard me. Yeah, it's all in.
All in 100%.
All in. So should we move on to the next company? You guys are asleep.
I say we just
All right.
give you some awkward silence for a bit, personally.
Voxtur Analytics Corporation. Brett's going to handle this one. VXTR and the TSX Venture. It's a micro to small cap.
Micro to small cap, yeah. He's just going to push it right on to me. He doesn't get the awkward silence.
Nope. It's only awkward for our listeners, so I try to fill it in.
All right, but Voxtur Analytics, symbol VXTR on the TSX Venture, is a real estate technology company. The company offers targeted data and analytics to simplify tax solutions, property valuation, and settlement services through the lending lifecycle for investors, lenders, government agencies, and services. The stock is down a whopping 78% year to date, and its current price is about 26 cents. The company recently had its Q3 earnings just last week, and management was highlighting these great revenue growths, 44% year over year, 42% gross profit increase year over year. But the story is different when you look at the quarter over quarter. Revenue dropped 7% in the last quarter compared to Q2, and gross profit increased slightly at 7%, but it's still down year to date. Well, compared to the first quarter, I should say. Management is forecasting revenue to be in the 140 to 150 million range, which does not include its recent large acquisition of Blue Water. But this does mean organic revenue. So organic revenue is revenue without the acquisition would be between 25.5 million and 35.5 million, which would mean revenue is expected to drop again quarter over quarter. And at this point, it would actually be year over year drop. So you're looking at a weaker housing market, which of course is a massive factor in this industry and for this company. But when you're posting these highlights of we're increasing, makes me quite skeptical when you're posting only increases when in reality they're slowing down. But then we'll look at net income, which has been a bit better in some ways for adjusted EBITDA, but net income itself has been just dropping quarter after quarter. It is even slightly better year over year, but once again, quarter over quarter, worse since Q4 2021, slightly better since Q4 2021. And it is just all over the place with EBITDA. And I don't know what to take of this. There's no real trend to it. So it's something which I'm looking at it and wondering, are they actually improving here? Are they going to create a positive environment in the future when there is a positive macro environment? Right now, there isn't, and they're up, down, up, down. So, but what I'm really watching right now for the company is their balance sheet. They've been taking on massive loans for their Blue Water acquisition, amongst other acquisitions in the past. This is through a line of credit, which they actually broke the covenants of for Q3. BMO has since waived that, so pretty much they're saying, hey, we believe you guys enough that you're not going to go bankrupt in the next year. So initially, on their actual Q3 earnings, they had it in their current debt, which means they have to repay it in the next 12 months. But now, since as of the earning calls, which was just a few days ago, they're going, hey, you can go back to before, so it's non-current, so it's about 3 to 5 years for most of these loans. But that's not to say they're in the clear. If they break these covenants over and over again, BMO might raise the interest rates. They might just say, you owe us all the money in the next 12 months, which is what their initial covenant breaking, if BMO did not waive it, would have occurred. So that's just terrifying as an investor, because if they called that, they would have most likely been in bankruptcy at that point. In addition to the debt issuance, the company has issued significant shares as well to help fund its various acquisitions. For example, the Blue Water acquisitions, their large acquisition just a few months ago, added 124 million shares. So that's about a fifth of their total shares issued. And these shares aren't all out, so you're not going to see on their basic EPS. They're all vesting over the next 16 quarters. So you're going to see continuous dilution of basic share in the next 4 years or so. There is a bit of positive news, though, in the last quarter. The company has just squeaked over the zero line. They've become positive for operating cash flow of $49,000. That's effectively zero. They're flat. but it's an improvement over the previous ones where they're 7 million for Q2, 6 million for Q1. And additionally, Blue Water is an accretive acquisition, so their cash flows will be ever so slightly higher, most likely, in the coming quarters. But that being said, the company does not expect free cash flow, which is just operating cash flow minus the investments. So whenever they're doing an acquisition, you would take that off operating cash flow, and there's your free cash flow. There's a few other things that go into it, but that's the rough understanding of it. And they're not going to be free cash flow positive until 2024. So you're looking at still another year of them burning through cash. So Arte, the company is just too risky to be investable. The company's capital structure carries significant risk due to the debt levels and the impending dilution. Revenue growth is stalled out in the harder real estate market. There is the glimmer of hope with a slightly positive cash flow, but I'm not really going to trust it. I'm not taking it. I've seen some comments online saying they're positive. It's $49,000. It's nothing. It something which in maybe 2-3 quarters from now, if they're $1 million or $2 million positive, I'd enjoy that. I'd like that. But for now, it's nothing. Maybe in a year or two, after the real estate market has bottomed and we actually have a better idea of where it's going, you could maybe consider it. But for now, I'm staying away.
Yeah. So
I'll open it up to you guys.
So after those shares vest, like the company should have is it about 700 million shares outstanding? Is that correct?
I think it's about 650 or so.
650? Okay.
And what's the market cap on it right now again?
I don't have that up.
About
100 something.
100, yeah.
Yeah,
160
million in debt.
120, 119. Yeah.
Yeah, 60 million in debt. So it is quite.
That's a lot of debt for a company their size. No profitability, no cap. I don't even understand how they get a loan when they're not generating.
The 30 million US was related, so 40 million Canadian was related to their Blue Water acquisition. So it's really pending off that, and they had.
So they incurred debt from the acquired company, right? Right.
Yeah.
Yeah, I mean that's and this is an example of a company. I mean they can really run into trouble when that debt comes due because how do you pay it? I mean there's either you pay it from internally generated cash flow or from getting more debt or from issuing shares, and there is no internally generated cash flow or virtually none. Banks are going to really be reluctant to loan them any money. And in addition to that, it's issuing shares to pay it off. They're going to have to further dilute. So it's a tough. If the market were hotter and there's a lot of excitement around that space, which there has been in the past, data analytics, then maybe you find somebody who's willing to back it. But at best, they could do is essentially go to their creditors and say, "Listen, we're not going to be able to pay it back. You have to extend terms," which they may be able to do. But, it's not going to give you a good reputation amongst creditors.
No. As at September 30th of this year, they have like a $40 million working capital deficit.
Okay, so you need to add that on. They need to come up with 40 million. Yeah. Just over the next year.
Current portion.
I should add that's because they had those covenant debt breaches. So in the next quarter, you're going to have the 60 million if I go back to non-current. So they are actually... Because BMO was so nice and they let them essentially say, hey, you broke the covenant, but...
it's not that BMO is nice. It's that BMO knows they're not getting money regardless. So they may as well extend it. And
I'm sure they've been told as soon as we bring this acquisition in the fold, we'll be generating a ton of cash flow. But I mean, but
eventually the creditors find to get 5 cents on the dollar if that's all they're going to get, right? Yeah. So, and that's basically, sell off your assets.
I mean, this company used to be called iLookabout, and we looked at it for a number of years. The capital structure here, since they got really aggressive on the acquisition front, they're just not paying attention to the capital structure. Like if they end up with 650 million shares out, a working capital deficit, I mean, it may shift if that the near-term debt goes to long-term debt. But it's a lot of debt for a company of this size in a servicing a sector that is facing some people are saying historical slowdowns near term here. So you couple all those things together with with that horrible capital structure. There's likely going to have to be a consolidation here. That's there's too many shares. You can just see that. And an equity raise at some point if they can come out on the other side of this. But I mean, they should be in cash conservation mode right now, and that's not a growth mode. And like Brett was saying, organically, it's not growing. From what we can tell,
Mhm.
it's just the acquisition growth here. Bring that in, and I mean, you're going to have to see some cost cutting just to keep the business going. Likely, I mean, at this point. So we'll see. We'll continue to monitor it, but it's not good to have debt covenants being broken, share structure out of control, and even if there's tons of revenue growth, I mean, we've seen companies implode before. I'm not saying that's going to happen to this business at all, but we've seen companies implode before with very strong revenue growth. But you gotta have actual cash flow, not 49,000 cash flow. That's not cash flow.
Yeah,
and you gotta bring that in because there's a lot of debt here, and there's 12 million or something in the bank, but you need more than that if you're going into a prolonged slump in the real estate sector.
Like like Brett said, even if they could produce, potentially $1 million in cash flow or something like that, like based on the capital structure and how much shares they have outstanding, that would only be 0.0017 cents in cash flow per share, which is
start producing 10 million in cash flow, and even
it's hard to create meaningful per share cash flow or earnings when you have that.
That's why you got to mine the capital structure, and that just hasn't been done here. And that's why we would say, if I had to make a prediction, if something else doesn't happen first, there would be a share consolidation and go through that whole song and dance.
You heard it here first.
Yeah.
And Brett's
I don't even think, looking at it, any analyst that's worth their salt,
if you're not getting ripped apart on the internet, you're doing something wrong.
That's the plan.
Yeah.
We'll probably have somebody who invests in it. They'll never do this. They'll never do a share consolidation.
Yeah, you guys.
And next day, within a week that's being announced.
Yeah. Perfect. Okay, well, I think that's it for you guys. Got nothing else to say, right? Thank God. Okay, so let's go. I thank everybody for keeping your questions coming through us. We're getting more and more questions every week. Smash that subscribe button on YouTube. And keep rating us and reviewing us if you're just listening to this on iTunes as a podcast. And again, we'd like to wish everybody out there profitable investing. Thank you.
Great. Thanks, everyone.
Thanks, everyone.
Thanks, everyone.